Welcome to Cotality's Housing Market Update for February 2026, brought to you by First National Real Estate. Australian home values started the year with a 0.8% rise in January, a subtle acceleration from the 0.6% increase recorded in December. While every capital city and broad rest of state region recorded an increase in home values through the month, the start of the year has returned a mixed result. Sydney and Melbourne are weighing on the headline numbers, recording a 0.2% and a 0.1% increase respectively in January, a marginal pickup following the slight falls recorded in December. Both markets have values slightly down on their peak levels, with Sydney down 0.1% from the November 25 peak, and Melbourne values remaining 0.7% lower than record highs back in March of 2022. The mid-sized capitals have continued their solid growth run, however some momentum has left the upswing in these cities as well. Perth values were 2% higher in January, the strongest gain across the capitals, but well below the cyclical high of 2.9% growth recorded in November last year. Similarly, Brisbane's monthly gain has slowed from 2% in October back to 1.6% in January, and Adelaide's monthly increase dropped back to 1.2% from a 1.8% rise in December. The further rise comes despite the most unaffordable conditions on record in many cities, along with a rebound in cost of living pressures and the prospect of higher interest rates. Yet, we've still seen broad-based rises in home values. The ongoing capital gains reflect persistently low inventory in the face of above-average housing demand. However, we are likely to see demand-side pressures gradually ease through the year ahead. Affordability and serviceability constraints are likely to naturally dampen demand, but also renewed cost of living pressures and higher interest rates. There's also slowing population growth to consider. From a supply perspective, Cotality estimates the number of homes advertised for sale in January was 21% below the 5-year average for this time of the year. At the same time, the rolling quarterly number of home sales was estimated to be 2.7% higher than a year ago and only 1.8% below the 5-year average. Digging a little bit deeper, most cities are continuing to see homes at the lower end of the value spectrum supporting growth, especially for houses. Across the combined capitals, lower quartile house values are up 4.7% over the 3 months to January, compared with a 0.3% rise across the upper quartile of the market. This trend of stronger growth conditions at lower price points is supported by intense competition for more affordable houses. This is where first home buyers, investors, and progressively, mainstream demand is most concentrated. Regional markets have delivered a stronger growth outcome, with the combined regionals index up 1% in January, compared with a 0.7% rise across the combined capitals. Regional South Australia led the growth tables in January with a 2.1% rise through the month, while regional markets of Queensland and Western Australia, as well as Tasmania, all recorded growth of more than 1% over the month. Switching our focus to rental markets, and the rental vacancy rate came in at 1.7% nationally in January, up from a recent record low of 1.5% in September, but still well below the long-run average of 2.5%, or even a year ago when the vacancy rate was 2.1%. With such low vacancy rates, Cotality's national rental index was up 0.6% in January, the strongest monthly change in rent since April last year. Similarly, the annual pace of rental growth picked up, recorded at 5.4% over the 12 months to January, adding approximately $35.20 a week to the median rent. Brisbane home values were 1.6% higher in January, a strong rate of growth, but down on the cyclical high in October last year when values rose by 2%. In annual terms, Brisbane housing values are up 15.7%, adding approximately $143,000 to the median dwelling value. Unit markets have stood out with a higher rate of capital gain than houses, with values up 18.3% and 15.1% respectively over the past 12 months. In fact, it's the lower quartile of the unit market that's really driving the highest appreciation, with a 23.4% surge in values over the past year. Australia's housing market is set to navigate an increasingly complex mix of headwinds and tailwinds over the coming year. While supply-side constraints and a resilient labour market continue to support values, housing demand is likely to be tempered by a range of headwinds. On balance, it's likely housing conditions will remain diverse around the country, but lose some momentum. That said, a material downturn seems unlikely unless economic conditions weaken a lot more than expected or more rigorous credit controls arise. Touching on the demand-side headwinds, we have higher inflation and the potential for higher interest rates. Affordability is stretched and population growth is normalizing after a period of catch-up. The cash rate rose by 25 basis points in February, and with inflation forecast to rise further, the RBA has left the door open for future rate hikes. Even without a further lift in the cash rate, the risk of higher rates is likely to erode confidence, while any actual increase will flow through quickly to borrowing costs and less purchasing power. From an affordability perspective, home values have risen significantly relative to incomes, and interest rates are a full percentage point above the pre-COVID decade average. As a result, both the deposit hurdle and ongoing serviceability assessments continue to present a substantial barrier for prospective buyers. After several years of exceptionally strong net overseas migration, the catch-up phase of population growth has moderated back towards long-run averages. While still positive for underlying housing demand, the step down removes some of the extreme pressure on housing demand. And we also have a more cautious credit environment, with APRA's introduction of limits on high debt-to-income ratio lending from February 1st, setting the tone for a more cautious lending environment in 2026. Additionally, the 3 percentage point serviceability buffer remains a formidable barrier to borrowers, especially if rates move higher. Finally, on the demand side, consumer sentiment is fragile. Household confidence has been subdued for an extended period of time, with a renewed downtrend in December and January reflecting cost of living pressures and uncertainty around the economic outlook. Weaker sentiment typically correlates with softer housing demand as buyers defer major financial commitments. But there are still tailwinds that are likely to support prices despite the softer demand-side conditions. Firstly, we have persistently low supply levels. Both advertised stock and new housing completions are expected to remain well below average. Construction costs are elevated and rising, making it hard for residential projects to stack up from a feasibility perspective. Established supply is also constrained, with listings in January almost 25% below the 5-year average for this time of the year. Attractive incentives for first home buyers are amplifying demand at the middle to lower end of the value spectrum. State and federal schemes remain supportive for eligible buyers, helping to offset some of the affordability challenges and channeling demand into that lower quartile of the market. These incentives, along with broader affordability and serviceability constraints, tend to amplify demand around the mid-range to entry-level segments, even when broader housing demand is softening. Ultra-tight rental markets are another factor supporting demand, nudging renters towards home ownership. Vacancy rates remain historically low, and rental growth has outpaced wages growth for several years. For households, the additional cost of paying down a mortgage relative to paying a landlord is likely to become increasingly attractive, especially if they can take advantage of government schemes aimed at supporting first home buyers. More broadly, we have labour market resilience and steady economic growth. Unemployment is expected to remain low by long-run standards, and the economy is forecast to grow around 1.9% in 2026. While that's not strong, this level of economic activity is generally supportive of housing, providing a buffer against distressed selling and broader market weakness. Overall, the year ahead is shaping up to be one of softer, more uneven growth. Demand is likely to be dampened by affordability and credit headwinds, while supply constraints and a still resilient labour market will act as important stabilizers. In this environment, a slowdown in value growth rather than a sharp reversal appears to be the more probable path, unless economic conditions or credit conditions deteriorate more than expected. As always, thanks for tuning into our housing market update. You can keep up to date with all the housing news at the insight pages of the Cotality website.